the Roaring '50s, a time of prosperity, hope, and optimism in America. But beneath the shiny veneer of post-war consumerism, a darker truth lurked. This is The Money Trail, where we investigate the untold stories of financial history. In 1945, World War II concluded, leaving behind a devastated world but also an economically surging America. Returning soldiers sought homes, jobs, and education under the GI Bill, fueling demand for housing, infrastructure, and consumer goods. Between 1945 and 1970, the U.S. economy grew by over 3 times its size in 1945. This period saw the rise of a new breed of businessmen who exploited this rapid growth to amass vast fortunes. Men like Charles Keating Jr., whose Phoenix-based Lincoln Savings and Loan Association would become notorious for defrauding thousands of investors out of $260 million in the late 1980s. However, it wasn't just individuals. Whole industries were tainted by corruption during this time. In 1954, congressional investigations revealed that the life insurance industry had engaged in widespread bribery and anti-competitive practices for decades. Top executives from companies like Equitable Life Assurance Society and Metropolitan Life Insurance Company admitted to offering kickbacks of up to 20% on premiums paid to agents who steered clients towards their products. These scandals weren't just about money. They eroded public trust in institutions and individuals, setting the stage for an era of cynicism and mistrust that we still grapple with today. They also exposed deep flaws in our regulatory systems, prompting calls for reforms that continue to this day. So join us as we delve into these stories of greed, deception, and power. Together, we'll follow The Money Trail through the biggest financial scandal of the 1950s, a tale of hubris, corruption, and ultimately, redemption. The Money Trail continues with an in-depth look at the key players involved in the biggest financial scandal of the 1950s, a tale that would forever change the landscape of Wall Street. At the heart of this web of deceit were 2 infamous figures, Harry Markopolos and Bernard Madoff. Harry Markopolos was a quiet but determined financial analyst who, in the late 1990s, began to suspect that something was amiss with Madoff's investment firm. As he delved deeper into the financial statements and records, Markopolos discovered alarming discrepancies and impossible returns that couldn't be explained by traditional investment strategies. He presented his findings to the Securities and Exchange Commission multiple times over the course of a decade, but his warnings fell on deaf ears. Bernard Madoff, once a respected figure in the financial world, would eventually be unmasked as the mastermind behind one of the most audacious Ponzi schemes in history. With promises of consistent, double-digit returns, Madoff lured thousands of investors, from small-time retirees to major institutions like banks and hedge funds. Over the course of nearly 2 decades, he defrauded his clients of an estimated $64 billion, using money from new investors to pay off earlier ones in a classic Ponzi scheme. The scale of Madoff's fraudulent activities was staggering, but so too were the red flags that had gone unheeded by regulators and industry watchdogs. Markopolos had repeatedly warned the SEC about his suspicions, even providing them with specific evidence and a detailed roadmap to expose Madoff's crimes. Yet, time and again, the SEC failed to act, leaving Madoff's house of cards to grow ever higher and more precarious. The fallout from this scandal would be catastrophic, not just for the victims who lost their life savings, but also for the broader financial system. Trust in Wall Street plummeted, and investors began to question the very institutions that were supposed to protect them. This era of cynicism and mistrust would persist for decades to come, as the scars from this scandal continued to fester and haunt the financial world. As we trace the money trail through the big